Welcome to RBC's Markets in Motion podcast, recorded January 23rd, 2026. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know. First, the various earnings stats we track point to a sleepy start to reporting season, suggesting to us that geopolitics hasn't been the only thing contributing to the U.S. equity market's recent gyrations. These stats also highlight how the megacap growth trade has seen its dominance on the earnings front erode in some ways, helping fuel the rotation to value in small caps. Second, our review of this past week's earnings call commentary suggests that views of the macro have been mixed, with geopolitical concerns and consumer pressures noted, but tariffs described as manageable. And third, things that jump out from our other updates include the rise in the Russell 2000's PE multiples, which are approaching 2024 highs. If you'd like to hear more, here's another 5 minutes. Starting with takeaway number 1, a sleepy start to earnings on the stats. One of our team members summed it up best, in our view, when he described earnings as a bit of a snooze so far. With just 30 companies reporting this past week in the S&P 500 following the 14 that came out the prior week, the rollout of 4Q25 results season has seemed a bit slow to get going, and geopolitics and other macro matters have dominated the spotlight. Given our view that price action in the S&P 500 this year will likely be anchored to the earnings backdrop, we have kept one eye on the geopolitical headlines and another on the evolving earnings stats and the transcript commentary. Here's what jumps out to us so far on the stats. To begin with, the consensus has come in very slightly. A few weeks ago, the bottom-up consensus 2026 EPS growth forecast tracked by Bloomberg had drifted slightly above 313. Though the latest stat still rounds to that number, what caught our eye is that the stat has now drifted slightly below it. Moving on, big cap beats aren't beating. The percent of companies beating consensus EPS forecast so far is tracking at 81% for the S&P 500, similar to where the last reporting season ended up at 82%. The Russell 2000 is off to a better start, with the percent of companies in the index beating consensus tracking at 69%, below the S&P 500 level, but importantly up from 66% in the last quarter. Additionally, earnings enthusiasm has been lacking. One of the biggest things that jumped out to us in this week's statistical updates is that the rate of upward EPS estimate revisions has continued to deteriorate from the peak put in place last fall. In our latest update, the rate of upward EPS estimate revisions for the S&P 500 has fallen to 51%, suggesting that upward and downward revisions are fairly balanced. This is far weaker than the 65.5% upward revision rate we saw for the index back in early September. Russell 2000 has been similarly weak at 50.5, but the good news for this corner of the U.S. equity market is that the S&P 500 is seeing its dominance on this stat erode relative to the Russell. Within the S&P, the rate of upward EPS estimate revisions has deteriorated for both the top 10 market cap names and the rest of the index, still well within positive territory in the former and close to balanced in the latter. The good news for the rotation trade has been, similar to what we are seeing in small cap, that the biggest market cap names are seeing their advantage on this metric erode relative to the rest of the index. After the first week of reporting season, when the big banks reported mixed results, we observed that the commentary still sounded like it supported a cautiously optimistic view on the year ahead. We stand by that comment, but think it's fair to say the caution is taking a toll on the numbers. Let's move on to takeaway number 2. What we read last week indicates that macro views have been mixed. As usual, our team combed through S&P 500 earnings call transcripts this past week, looking for breadcrumbs on the macro backdrop and other commentary on key themes in the equity community. Here are our general impressions of what we read. Overall, the description of the macro from the companies that reported this past week came across as mixed, similar to the cautiously optimistic tone we heard from the big banks in week 1. Geopolitics and uncertainties from trade, tariffs, and conflicts were noted by companies in multiple industries this past week, also similar to what we heard the prior week. On the more positive side, strength in copper prices emanating in part from the tailwinds of electrification and data centers was highlighted. Several REITs and financials noted improving customer sentiment and stable consumers. In the consumer conversations, value consciousness, affordability concerns, and an ongoing desire to stretch budgets were noted, similar to what we've read in past weeks and quarters. The prior week, some of the big banks noted their consumer stats all still looked pretty good. As was the case in week 1 when the big banks reported, the conversation around AI use cases and impacts continued to be lighter and less specific than we'd been hoping for as 4Q25 reporting season got underway. Most of the companies that offered comments emphasized their investments and highlighted positive impacts on customer experience, productivity, and customer analytics, along with more efficient technology engineering. Tariff comments indicated how the situation is still evolving and that current law is what's embedded in guidance. Ongoing mitigation efforts stayed in focus. Several companies noted that their customers have adapted to tariffs, but that it's treated more like a planning assumption rather than an impediment, while another noted that companies have gotten comfortable with tariffs. Several companies emphasized their own targeted or surgical approaches to pricing. In terms of other policy topics, one healthcare company noted they did not expect adverse impacts from the loss of ACA subsidies, while another noted they hadn't seen evidence of impact either way. Meanwhile, one homebuilder noted they were pleased that the administration had acknowledged housing affordability as an issue. An oil company expressed optimism about opportunity in Venezuela. One financial noted positive impacts from last year's tax bill had not yet been realized for consumers. For the most part, companies that commented on policy issues emphasized the positive aspects or manageability of them. The topic of an interest rate cap on credit cards remained a key exception, with one financial explaining why they believed such a measure would reduce the availability of credit and impair the economy. This was similar to commentary we read the previous week from other financials. And we'll wrap up quickly with takeaway number 3. What else jumps out? After a strong start to the year for the rotation trade, the main thing jumping out on our stats are some of the shifts we're seeing in PE multiples. We continue to track forward NTM PEs for the S&P 500, its top 10 market cap names, and the rest of the index. Generally, we've seen some slippage, but multiples remain elevated. Small caps are a different story, however, as the Russell 2000's PE on both FY2 and NTM continue to rise. The Russell 2000 PE is back to its 2024 high on NTM, 19 times, and is getting close to it on FY2, 17.9 versus 18.1. This represents another pivotal test for the Russell 2000, which still has considerable room to run, in our view, if it embarks on a return to all-time highs on the PEs. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative with any questions.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.